Listen to me, I want you to picture a woman named Margaret. It's a Wednesday afternoon in April of 2026, suburban Phoenix, the kind of dry, bright, merciless afternoon where the light comes through the kitchen window and lands on everything you've been avoiding looking at. Margaret is 71 years old. She is sitting at her kitchen table in a house she and her husband Frank bought in 1988, and there is a casserole dish in her freezer that one of the neighbors brought to the funeral that she still cannot bring herself to throw away. Frank died 7 weeks ago. 49 years of marriage. He was a structural engineer, spent his whole career making sure other people's buildings didn't fall down. And he had a heart attack on a Sunday morning while he was out front coiling the garden hose. He was 73. He'd just taken his first required minimum distribution 4 months earlier. He used to joke that the IRS waited until you were exactly old enough to need the money before they came for it. Margaret is not crying right now. Margaret is doing something worse than crying. Margaret is reading a letter from their accountant for the 4th time, and her stomach is somewhere down around her knees because the letter is telling her, in calm, professional accountant English, that this year the federal government of the United States is going to take roughly $68,000 out of her retirement income. $68,000. Last year, the same household, the same accounts, the same money. The tax bill was about $16,000. Now read that again, because nothing went up. Margaret's income didn't increase, it dropped. Frank's Social Security check, the bigger of the two, stopped the month he died. Their household income fell by almost $30,000 a year. Margaret is poorer than she was when Frank was alive. She is grieving. She is alone in a house built for two, and her tax bill just quadrupled. That is not a glitch. That is not an accounting error. That is the federal tax code working exactly the way it was designed to work the moment the hearse pulls out of the driveway. It has a name. It's called the widow's penalty. And almost nobody, not your broker, not your banker, not the nice man with the framed certificate who sold you the annuity in 2014 and buys you a coffee twice a year and calls it a review, almost nobody's going to warn you about it until it is far, far too late to do anything. I'm going to warn you right now. Welcome back to the archive. I'm the retirement insurgent, and today we're tearing the roof off a mathematical guillotine built into the tax code, a trap that drops the day one spouse dies and quietly bleeds the survivor for the rest of their life. Here is the part they hide from you. When your spouse dies, you don't just lose your partner, you lose your tax status. And the United States tax code treats a married couple and a single person so differently that the survivor, already grieving, already poorer, already alone, gets hit with a tax structure that was engineered to extract more from less. The IRS is not neutral here. I want you to understand that. The IRS is not a passive scorekeeper. The brackets, the thresholds, the surcharges, they are all built on an architecture that quietly assumes that when one of you dies, the survivor won't have the cognitive bandwidth in the worst year of their life to fight back. And the IRS is right. Most don't. That's the whole bet. There are roughly 800,000 new widows and widowers in this country every single year, and the widow's penalty is one of the largest sources of stealth revenue in the entire federal tax system. Billions of dollars a year pulled from grieving spouses who never saw it coming and never knew it had a name. But before we go 1 inch deeper into the machinery, I need you to do something for me right now. Hit that like button, not at the end. Now, smash it. Because the algorithm in 2026 has a documented suppression problem with senior financial truth. The platforms don't want this content reaching the people who need it. The IRS relies on quiet, isolated, grieving spouses sitting alone at kitchen tables with no advocate and no warning. Every like on this video shoves it into the feed of one more couple who still has time to fix this while both of them are alive. Subscribe, flip the bell, join the archive, because what I'm about to tell you, your CPA didn't volunteer, your financial advisor skipped in your last review, and your estate attorney never mentioned when you signed your will. The suits in legal want me to say this isn't financial or tax advice. Fine, it isn't. It's a survival guide for a vault nobody's guarding. Go consult a professional if you still trust the same kind of professional who told Frank to just keep deferring for 40 years. This is the masterclass they never gave you, and it is going to make you absolutely, righteously furious. Let's go to work. Let me show you exactly what happened to Margaret, line by line, because the horror lives in the arithmetic. In 2025, Frank and Margaret filed jointly. Here's what their income looked like. Frank drew a Social Security check of about $3,600 a month. Margaret drew $1,900. Combined, that's $66,000 a year in Social Security. Frank had a small pension, paying $18,000. They had a traditional IRA, mostly Frank's rolled over 401k, sitting at about $760,000, and his required distribution that year ran about $29,000. They had a brokerage account throwing off $6,000 in dividends and a couple of CDs paying another $5,000 in interest. Added up, call it $124,000 of gross income for the two of them. Now here's the part that mattered, the part they were about to lose. As a married couple filing jointly in 2026, the 12% bracket stretches all the way up past $96,000 of taxable income. After their standard deduction, their senior add-ons, the works, most of their income sat in that low bracket. Their effective federal rate was somewhere around 7%. They felt fine. They were fine. Then Frank dies in April. And here's the trapdoor. The IRS sets your filing status by where you stand on December 31st. There's a narrow grace window called qualifying surviving spouse that keeps the joint brackets for 2 more years, but only if you have a dependent child living with you. Margaret's kids are in their 40s with their own mortgages. She gets 0 grace period. She files single in 2026. The full year. Now watch what happens to the exact same money. She loses Frank's Social Security check. The household Social Security drops from $66,000 down to about $43,000. Frank's pension had a 50% survivor benefit, so the $18,000 becomes $9,000. The IRA is still roughly the same size, and her required distribution as the survivor is still in the high 20s. The dividends and the interest don't change. Her gross income just fell by about $30,000. She is meaningfully poorer. And here come the blades, 3 of them, stacked, fired in sequence. Blade 1, the bracket collapse. This is the one most CPAs will at least mention. When you go from filing jointly to filing single, the brackets don't just shrink a little. At almost every level, the single brackets are roughly half as wide as the married brackets. Look at the 22% bracket. For a married couple, it runs from about $97,000 up past $200,000, or that's over $100,000 of room. For a single filer, it runs from about $48,000 to $103,000, about half the width. Same at the 24% line. Same at the 32% line. The entire architecture is built for 2 people, and the second one of them dies, the survivor falls straight through the floor into higher rates on less money. Margaret's taxable income, after her now halved standard deduction, lands her across the 22% line, paying 22 cents on the dollar on income that, as a couple, would have been taxed at 12. Blade 2, the Social Security torpedo. Here's the dirty part. The thresholds that determine how much of your Social Security gets taxed were set in 1983 and 1993 and have never been adjusted for inflation, not once in over 40 years. That's not an oversight, it's a stealth tax that gets more punishing every year inflation runs. And the single filer threshold is lower than the married one. For a couple, the protection runs to $32,000 of provisional income. For a single filer, it's $25,000. So the moment Margaret files single, more of her Social Security, up to 85% of it, gets dragged into taxable territory. Income that was partly shielded the day before Frank died is now fully exposed. Blade 3, the IRMAA, surcharge. This is the silent assassin, and it operates on a 2-year delay specifically, so you can't connect cause to effect. IRMAA, the income-related monthly adjustment amount, is a Medicare premium surcharge that kicks in when your income crosses certain lines. And it's a cliff, not a ramp. Cross the threshold by a single dollar and your Part B and Part D premiums jump for the entire following year. While Frank was alive, their joint income kept them comfortably under the couple's threshold. Now Margaret is measured against the single threshold, which is far lower, and her required distribution plus her newly taxable Social Security shoves her over it. Her Medicare premiums climb by hundreds of dollars a year, and because of the 2-year look-back, the bill for what's happening to her in 2026 won't even arrive until 2028. By then she'll have forgotten what triggered it. That's not an accident, that's engineering. 3 blades. The bracket collapse hits the year of death. The Social Security torpedo hits every year after. The IRMAA surcharge hits 2 years behind. Every time her income so much as twitches. The woman who paid an effective 7% as half of a couple is now paying close to 4 times the tax on less money for the crime of being widowed. Stop the video right now. Go to the comments. Tell me honestly, look, have you and your spouse ever sat down and run the numbers on what your taxes look like the day after one of you dies? I'm betting almost none of you have because nobody ever told you to. Tell me your ages. Tell me roughly what's in the traditional IRA and whether your pension has a survivor benefit. The comment section is the field hospital. I read every one. So who designed this? Who sat in a room and decided the cleanest way to pull generational wealth out of the middle class was to wait until one spouse died and then change the math so violently that the survivor, drowning in grief, wouldn't fight back? Here's the uncomfortable truth. Nobody had to design it as a single evil act. It was known and left in place, which is worse. The Joint Committee on Taxation has understood the widow's penalty since the 1980s. There have been white papers. Brookings has written about it. The American Enterprise Institute has written about it. AARP has written about it tepidly. The information has been sitting in plain sight for 40 years, and every Congress that could have fixed it chose not to. Why? Follow the money. 800,000 new widows and widowers a year. The typical 65-plus survivor sitting on a traditional IRA is somewhere between 250,000 and 1.5 million. The marginal rate jump from the bracket collapse alone, multiplied across that entire population, generates billions in incremental revenue every year. The IRS calls that revenue. You and I call it harvesting the grieving. And here's the part that should genuinely make you furious. The same industry that's supposed to protect you is structurally pointed the other way. The traditional IRA, the deferral, the stay the course, that we'll deal with taxes later. Well, all of it generates fees and assets under management for the advisor today, while loading a tax bomb that detonates on your spouse after you're gone. The advisor doesn't see your widow's tax return. He's not structurally on her side. He can't be. The incentives all point at deferral, and deferral is precisely the fuel for this fire. Send this video to a married couple you care about right now. Today, not tomorrow. Pull out your phone, hit share, send it. One conversation tonight between 2 spouses who are both still alive saves the survivor roughly $75,000 over the next decade. That's not a sales pitch. That's the math we just did with Margaret. The cost of doing nothing is 6 figures. The cost of a 30-minute conversation after dinner is 0. Send it. Save this video right now. Hit the bookmark, the save, whatever your app calls it, because what comes next is the survival manual and the 4 assets you have to move while both spouses are alive, because every single one of these tools requires 2 living people with the legal capacity to sign. The day the diagnosis comes, half of them are off the table. Asset 1, the traditional IRA. The fix is Roth conversions. This is the single biggest source of widow's penalty damage and the single most important move in the entire playbook. Every dollar in a traditional account is a dollar of future ordinary income with the IRS's name already on it. When the first spouse dies, every required distribution after that comes out at the brutal single-filer rate. The fix: aggressive, multi-year, planned Roth conversions while you're still married and filing jointly, using those wide joint brackets as a runway. You convert chunks, calibrated to fill up the 12% and 22% brackets without spilling into 24%. You pay the tax now, voluntarily, at a known rate in a known year, and that money becomes permanently tax-free. No future required distributions, no tax on the growth. And critically, when one spouse dies, the survivor inherits a Roth, which throws off 0 taxable income and never touches the IRMAA or Social Security calculations. You're converting a recurring lifelong tax liability into a one-time payment made in the cheaper brackets. Done over 5 to 7 years, the lifetime savings for the survivor can run well into 6 figures. Asset 2, the taxable brokerage account. The fix is the step-up in basis and the titling. Most advisors get this exactly backwards. They tell couples to gift appreciated stock during life. For a couple where one spouse may die first, that's often the worst possible move. Here's the secret weapon: Internal Revenue Code. Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis resets to the fair market value on the date of death. All the embedded capital gain gone forgiven. If Frank bought $100,000 of an index fund that's now worth $240, Margaret inherits it with a fresh basis of $240 and can sell it the next day for zero capital gains tax. But this only works if the asset is titled correctly at death. In a non-community property state, jointly held assets often get only a half step up. In a community property state, and Margaret's in Arizona one of them, properly titled community property can get a full 100% step up. The wrong titling on a brokerage account costs the survivor tens of thousands in capital gains that never had to be owed. Talk to an actual estate attorney about how your account is held, not a generic advisor. Asset 3, the unprotected pension. The fix is the survivor election, or pension max. This one is the silent killer. Most pensions default to a single life payout unless the retiree affirmatively elects a joint and survivor option. And electing single life on a qualified plan requires the other spouse to sign a notarized waiver, which people sign all the time without understanding they're signing away their own future income. The single life option pays a bigger check while the retiree is alive and zero after death. If you're pre-retirement, elect the highest survivor percentage you can afford. If you're already locked into single life, you can't reverse it. But you can run what's called pension max. Buy a permanent life insurance policy on the pensioner side to replace the lost stream. The death benefit pays out income tax-free under Section 101A, and the survivor uses it to replace the pension, tax-free, no bracket exposure, no IRMAA spike. Frank's pension had a 50% survivor benefit, which is why Margaret still gets $9,000 instead of zero, 100% election, or a pension max policy, and she'd have kept all of it. Asset 4, the CDs and taxable bonds. The fix is restructuring the income before death. Most retirement age couples have somewhere between $50,000 and $300,000 in CDs, money markets, or treasuries, kicking off fully taxable ordinary interest every year. While both spouses are alive, that interest hides inside the wide joint brackets. The day one dies, the same interest stream gets shoved into the narrow single brackets and can push the survivor across an IRMAA cliff. The fix: restructure it to produce tax-free or tax-deferred output before the death. Options include high-quality municipal bonds from your home state, federally tax-free, and state tax-free too if they're in state, a multi-year guaranteed annuity that compounds tax-deferred so the interest doesn't show up on a 1099 every year, or properly structured cash value life insurance where the growth is tax-deferred and the death benefit pays out income tax-free. The right structure depends heavily on your state. A Florida retiree with no state income tax plays this completely differently than a California one in a high bracket. Let me put two widows side by side. Same age, 71, same husband, dead at 73, same starting balance sheet, a $760,000 traditional IRA, a paid-off house, a brokerage account, a pension, some CDs. The only difference is that one couple did the work 5 years before they needed to, and one didn't. Margaret A., no plan. Frank dies. The IRA is still fully traditional, so every required distribution comes out at the single rate. The brokerage was titled to get only a half step up, so she eats capital gains when she sells. The pension was 50% survivor, so she lost half of it. The CDs keep throwing off taxable interest that drags her Social Security into tax and shoves her over the IRMAA cliff. Her annual tax bill, plus the surcharges, runs around $68,000 a year. Over 20 years of widowhood layered with the compounding losses, more than $1 million of what Frank built quietly bleeds out to the federal government. Margaret B., the insurgent plan. 5 years before Frank died, the couple ran a Roth conversion ladder, converting chunks of that IRA into a Roth in the wide joint brackets, paying the tax voluntarily at known rates. They confirmed the brokerage was held as community property for a full step-up. They elected 100% survivor benefit on the pension. They moved the CD money into in-state munis and a tax-deferred wrapper. Frank dies. Margaret inherits a Roth that throws off no taxable income, a brokerage with a clean, stepped-up basis she can sell tax-free, a full pension, and an income stream that doesn't touch IRMAA. Her tax bill is a fraction of Margaret A's. The widow's penalty has been mathematically defunct. Same gross income, same grief, different account architecture, and roughly $1 million of difference over her remaining life. The difference between those two women is not luck. It is not how much they loved their husbands. It is 5 years of foresight and the willingness to pay some tax voluntarily on your own terms in a year you choose, instead of involuntarily on the IRS's terms in the worst year of your life. So here is what you do. Tonight, if you're married, while you both still can, sit down at the table after dinner. Open a notebook. Write down the 4 asset categories: traditional IRA, taxable brokerage, pension election, CDs, and bonds. Next to each, write what you own and how it's titled. That's step 1, and it costs nothing. Step 2, find a fee-only fiduciary advisor or an estate attorney who actually understands the widow's penalty. Not a salesman with a product to move, someone who'll run the conversion math and the titling with you. Step 3, start the Roth conversion ladder this year, because it takes 5 to 7 years to do it right without spiking your own bracket, and the clock only runs while you're both alive. And understand the window is narrower than you think. Roth conversions take years. Pension elections lock at retirement. Life insurance needs both spouses relatively healthy to underwrite. Trust restructuring needs both spouses with legal capacity to sign. If one of you is already in declining health, half these tools are already gone. The IRS is counting on you to wait until it's too late. Tell me in the comments which of the 4 you're starting with. Tell me your state, roughly what's in the IRA, and whether your pension has a survivor benefit. I read every single one. We build the analysis together. And subscribe. Flip the bell. Join the archive, because over the next 90 days, I'm publishing the full series, the Roth Conversion Ladder Walkthrough, the Step-Up Titling Guide, state by state, the Pension Max Breakdown. The moment a new IRS ruling drops, I post the live math within 48 hours. You want to be inside the archive when it does. Smash that like one more time on your way out. Break the shadow ban. Force this into the feed of the next 10,000 couples who think their standard 401k and their default pension will protect the one of them left behind. They won't. The defaults are calibrated for government revenue, not for surviving spouse protection. There are 800,000 new widows and widowers in this country this year, and the IRS is sitting back patient, watching the calendar, knowing most of them will walk straight into this trap. You don't have to. Your spouse doesn't have to. The escape hatches are written into the same chapters of the tax code as the trap. You just have to read them before the funeral, not after. You can be Margaret reading a $68,000 letter at a kitchen table 7 weeks after the worst day of your life. Or you can be the couple who saw it coming, did the work, and made sure that when one of you was gone, the other one kept what you spent 49 years building. Move those 4 assets before the IRS gets the chance to take half. I'm the retirement insurgent. This was the archive. Stay sharp. Stay angry. I'll see you in the next one.